let's get started. Here's our quick agenda for today, going through a more abbreviated version of some of the macro signals that are out there at the moment, and then kind of our thoughts around stocks, bonds, and what's going on in the volatility markets, which we haven't really touched on in quite some time. Just a great picture here for those of you that have been watching with great interest, the 100-foot wave on HBO. This is the picture of Nazare. But I think why I've decided to put this in here is, if you notice in that series, there is a lot of churn, punctuated by some brief periods of very dramatic occurrences that I think we're kind of in the middle of that at the moment. First, shifting to the economy side, the U.S. economy. Of course, the reason we focus on economic data, just to some degree, is because economic volatility definitely helps inform asset price and asset price volatility. And I think what's interesting here is that after a number of months of declining economic activity, looked like actually going into June, into July, that both the services and the manufacturing sector would be in recession. That would be a dip below this dotted line here. And again, just to reference, purple line is the services index for the U.S. The orange line is the manufacturing index. And while we have been in a quote unquote manufacturing recession for a little bit of time, since basically Q3 of last year, there does actually seem to be quite a bit of bottoming or basing here, as I indicate with these lines. And more recently, service sector has actually shown quite a bit of strength that has been a little unexpected by economists. So definitely this is, in my opinion, very characteristic of what I would consider to be some later cycle activity within the economies, as price increases are put through for wages, and inflation kind of works its way through the system. And we'll just have to see how this is evolving, but it does appear that the two main parts of the economy are actually stable and rising. This is the first time that's been the case for quite some time. So that's a positive, I think, for sure. Still have some deciphering to do here with relationship to the yield curve. And what you're seeing here on the screen, last month I showed the 10-year versus 3-month yield spread. And that was showing, again, similar to other or prior periods, right in advance of a recession, was that the bottoming of this ratio had occurred and it was heading higher. And just for reference, the moving higher in this ratio, meaning that the 2-year bond is rising, or I'm sorry, 10-year bond is rising relative to the 2-year, that generally almost always precedes recessionary conditions. Now, some of the modifications I think we're making to our ideas here is that it's probably, we could be evolving into a situation where some of the recession has already been priced in by asset prices, particularly last year. Maybe part of the equity markets have reflected this dynamic and are looking past it. We still have some time to tell before that's a definitive reading, but that's some of the initial thoughts that we may be having here at the investment community level. Also late cycle, but indicative of strength in the underlying economy is strength in the commodities markets. Again, we generally haven't put a lot of focus on commodity markets because commodities as an asset class, we've owned them on and off over the years. I definitely don't believe that commodities as a category are a permanent fixture in the portfolio, more something to add to or remove from the portfolio as valuations or relative value indicates. But what you're seeing here is this broad-based, and this is a year-to-date picture, this broad-based strength in the commodity markets. And that's, of course, most acutely seen right now in the energy markets, oil in particular. But also, if you look at things like food markets like cocoa or wheats, grains, those are all very strong right now for different reasons, which I think is a good thing. It's for different reasons, not because of some global calamity with climate at the moment. But these are all rising, and I think that just more indicates global economic strength as opposed to some of the naysaying that's going on right now that we're about to fall off a cliff. I just don't see that as a high likelihood at the moment. So back half of the year themes, we've been, adjusted these last month, and they're pretty consistent with with this month as well too, commodities, I think it's certainly important to be mindful that commodities are on the rise again. We have made some adjustments within sort of single stock portfolio as well as some of our model portfolios to benefit from some of this exposure, but that through the equities, not necessarily through the commodities themselves. But I think the fact that commodities are strengthening is a positive sign that we may be on the other side of what could be challenging economic conditions. It still is an expectation gap, and I think that's really important to keep in mind because valuations in the stock market are still on the elevated side. So they're suggesting that earnings will be growing more rapidly in the future. So the market can and will grow into valuations. We just have to be careful with certain parts of the market, particularly technology, of course. That's the area everyone loves to point a finger at, but it's also the area of the economy now that is growing the fastest. So I think that does make sense that would be probably the most highly valued part of the economy. But we have to be mindful, and I think, as you'll see at the recommendation slide at the very end, exhibiting just some basic risk management around some of those positions, I think, is the way to handle those at the moment, not wholesale exits. Opportunities are still on the horizon in a few areas. We did take some action on REIT exposure. We've started dipping our toe back in on the REIT side because it does, very negative sentiment on the real estate side still is out there. And I think investing into some of those very negative situations is generally a good recipe for strong long-term returns, particularly now that yields on the REIT side have re-rated pretty materially higher over the last 18 months. High yield bonds still don't make a lot of sense to us, as does preferred stock or some other more risky parts of the fixed income market. So we just need to be careful and wait for our opportunities when those do arise, because there will be an attractive opportunity to get the exposure there. It's just not right now because valuation is a little stretched on that end. And then I think we still have kind of a wait and see approach to what the Fed's going to do. That is a key player in what happens over the short and intermediate term, because I think there is still some ambiguity, particularly coming out of the Jackson Hole conference that occurred 2 weeks ago, with all the Fed governors, some indicating that there was scope for further rate hikes to make sure that inflation was tamed, some indicating that the job has been done, now we need to wait and see. I think all that says is we need to be cautious and not take too aggressive of a position, particularly around long-term bonds, which, as those of you may know, we still have no exposure to, any bonds that are longer than roughly 5 to 7 years at the most. And our preferred exposure on the bond side is still in that, call it 2 to 3 year window. And we'll talk a little bit more about that positioning as well too, because, now we're starting to get into the territory of, all right, are we taking on any excessive reinvestment risk in our bond portfolio if rates decide to fall pretty dramatically from here, if the Fed starts cutting rates? And I'll touch on that in just a moment. Our rating scheme here hasn't really changed very much. I would just point out we upgraded last month municipal bond exposure to a more attractive view from a neutral. That's because yields on municipal bonds have migrated a little bit higher over time, just kind of in lockstep with Treasury rates. And I've got a slide here later to show why we made that upgrade. But that's really the only change that we've made so far. Still have a bit of an overweight to U.S. large cap. We did add some mid cap exposure, waiting on to add the small cap. Still have no emerging market exposure, and any international stocks we have in our portfolio are international developed in a broad basket. And then, of course, still have a preference for alternatives, because these types of environments that have potentially higher levels of volatility and can earn return a little bit different way, have a way of working in these types of environments. On the U.S. stock side, just trying to touch on things that we haven't really touched on before to give you a sense of what we're thinking about. But I did want to point out, still having a little bit of a cautious tone and getting too aggressive in U.S. stocks. I think one of the reasons is because of what you're seeing in front of you, which is, this is a chart of Citigroup, and just for reference, Citigroup, I believe, is the third largest bank in the U.S. With a balance sheet in the hundreds of billions. I couldn't tell you exactly what it is, but it's a very sizable bank. And what I just wanted to point out here is that Citigroup is kind of emblematic or a proxy for the overall economy, because if monetary policy is the lifeblood of the economy, or money is the lifeblood of the economy, then the banks are the heart, meaning that they're the mechanism by which money gets distributed around the economy. And if banks are pulling back on lending or being much more cautious, then that means less money is going around the economy, and by extension, less credit is being extended to borrowers, and that just reduces growth over maybe a bit longer term time horizon. So I guess what we're pointing out here is that if the banks are not necessarily rising commensurate with the overall economy itself, then that's a big disconnect that we need to try to get to the bottom of and figure out why. Because I think what this could be signaling is that the pause in the economy could be coming sometime later in Q4 and maybe into Q1 of next year, and that we'll be watching to see how banks respond to that pause, because if they get much more conservative, then obviously that would not be a great setup for other parts of the economy like real estate or even technology for that matter. And so just exhibiting some caution, because if the banking system is not reflecting this overall ebullience or growth or optimism in the economy, then I think we've got some more caution to be taking in some of the equity portfolios. This is in the U.S. The proxy for Europe, Deutsche Bank, is one of the largest banks in Europe. This chart goes back to 10 years. And would you be surprised to know that it's a very similar picture in Europe, where banks are still under a bit of stress? It means Credit Suisse having to be taken over by UBS earlier this year, I think was their Silicon Valley Bank moment, if you will. But once banks start to fail and exhibit issues like that, solvency issues, then they usually don't just end at onesies and twosies. They tend to cluster, and I think that's kind of what I'd be looking for here, is if any more signs of any more stress across the European banking and U.S. systems, to get comfortable with knowing that the worst is maybe behind us. And that's just going to take some time to see how that evolves. But the fact that basically Deutsche Bank hasn't gone anywhere, going back to probably 2016, I think just tells you that investing conditions in Europe are still a bit challenged, and that we want to have probably an underweighted exposure to our target, which, as you all may know, has been the case for at least 10 years in our equity portfolios. And then I think the big question mark that's out there is what to think about China, because this is the second largest economy in the world. Stock market in China, of course, is much smaller than Europe or the US, but nonetheless, it's a very large economy and economic bloc, and worth paying attention to, because issues or reverberations or credit issues that happen there will probably have some impact somewhere in global markets. And I think the fact that now China, this is the FXI, so this is the iShares large cap Chinese ETF, and I think the fact that what appeared to be market improvement in the Chinese market up and through 2021 has really decidedly turned the other direction, and this was punctuated by, first, it was Evergrande, which was the first property company in China to indicate they were going into bankruptcy or having solvency issues. And then Country Garden was the next one that happened here. So I think what this represents is, again, stress in the financial system in China, and thereby stress in the real estate sector in China, which has precluded us from having any exposure whatsoever really to Chinese markets, really ever since 2009-10. When I removed that from our model portfolios back then. But it's just something to keep an eye on, because, again, unless we see an uptick or some improvement in Chinese markets, there's really no reason to believe as well, kind of similar to the thoughts I was having around Citigroup and Deutsche Bank, that investing conditions really haven't improved materially, and that we need to be a little bit cautious on the equity side. Again, not exiting our positions wholesale, but more maybe migrating to areas that potentially haven't done as well on the US side, or trimming back positions that have overshot here in the 2023. And this just shows you how much of a decline Chinese real estate has taken since May of 21. You can see this is really the big catalyst for the reason their market's going down here more recently, is that the Chinese real estate index is down, roughly 82, 83%. This was as of August 18th, so as of last month, but still nonetheless a pretty dramatic fall. So, when things start to decline by that magnitude, they do start to pique interest, of my interest. Not to say we would be adding any Chinese real estate companies to our portfolio, but more giving us a signal potentially that the worst could potentially be behind Chinese real estate companies. But I think maybe other bankruptcies or other solvency indications would need to come out before I think we got too much more excited about China being on the mend. Again, another chart here. I showed it in the 2 minutes podcast, but just nonetheless, I wanted to also mention, how much things have changed since the last called the dot-com bubble in 2000. And that the other aspect I think that this chart does a nice job of is that the leaders of prior cycles in the market are very rarely the leaders of the next cycle. Because you can see here the S&P return, this is the line down here, 200% from March of 2000 to June of 2023. There's only two companies on here that actually kept up with that return. That was Oracle and Microsoft. Everything else was either negative or, in the case of Cisco, GE, Intel, Citigroup, coincidentally, Lucent, and AT&T. And the other standout was ExxonMobil, which was one of the other cohorts, top 10 stocks in the S&P at that time. And so all that is to say is, leaders today, like what we're seeing with the Magnificent Seven, that's, the Microsoft, Amazon, Google, Tesla, and the like, are unlikely to be the leaders for the next, call it 20 years. So having a more flexible mindset about what is to come in the future, I think, is really the reason I wanted to show this chart, because again, gravity will eventually take hold with some of these companies. And I think expectations will start to wane as new business opportunities come around, disruption happens to business models. And I think this is just kind of a poster child chart for, be flexible in the coming years. So I do think this is a really important chart to continue to show, and I probably continue to show this until we reach some sort of topping out point. But until the 10-year bond, this is the chart of the 10-year bond going back to, this is 20 years. So it goes back to 2003. You can see, maybe not too coincidentally, we're actually at about the same level we were in 2003. And rates back then, before the financial crisis hit, were just a little bit higher from where they are today. And I think that's kind of a key demarcation point, is that, one of the things, we'll be looking at and watching for is a break potentially above these levels right here, which would be, 445, 450 on the 10-year, I think would potentially signal a market trend shift in interest rates. Now, how long can they stay above that level? That's a question that's certainly open for debate, because then you run into potential budgetary issues at the federal level, which I think will be more pressing in the years to come. But I think the point here is that until the trend in 10-year bonds and 30-year bonds, for that matter, until they kind of, it looks like yields start to peak out, we won't really have much interest in bonds in those ranges. And it's also just going to make, another comment to make along those lines is that as bond yields continue to rise, that creates more volatility generally within bond markets, and that just creates for more uncertain outcomes in other asset classes. So again, trying to be as cautious as we can into this period of uncertainty around interest rates, I think is the name of the game here. And just a little bit on, and I showed this yesterday, 2 minutes with Todd, but this is a chart as to why we think municipal bonds might make some sense now, particularly relative to things like either treasuries or corporate bonds in particular. And I think one of the big reasons you would want to take a look at municipal bonds is actually by and large, their default rates are measurably lower than their corporate comparables. And interesting side note is that municipal bonds also issue taxable debt as well. And there are situations where municipal taxable debt is, comparably yielding to corporate debt. So certainly, absolutely, we'll take those opportunities when we see them for a single bond portfolio accounts that have individual bonds. Then we have started adding some of those. But it's a little bit of a shift where up until maybe call it June, we've been pretty active in municipal or treasury and agency bonds now, and to some degree corporates for those taxable accounts. But now starting to shift a little bit into municipal bonds because credit ratings tend to be quite a bit higher, and yields are very comparable, particularly on an after or a tax equivalent yield basis. So we just wanted to point that out and highlight it. It is a little bit of a subtle shift, but one that we thought was worth noting. And then this is what I was talking about earlier, talking about complacency in the volatility markets. The purple line is the volatility index or the VIX index. High yield bond spreads, just kind of another proxy for volatility, just meaning how much in excess of a treasury does a high yield bond earn at the similar duration level. And what you're seeing here is that over the last, call it year and a half, almost 2 years, we're at some of the lowest level in equity market volatility, and also at some of the lowest level in high yield bond spreads that we've kind of seen here in the last 2 years. So I think whenever we start to hit trough levels of these types of risk measurement indexes, that just piques our attention to say, hey, we probably need to be a little bit conservative here coming into Q3 and into Q4. Certainly that's been the case. I think August has been a negative month for the S&P. September is following suit so far as well. So I think, if this goes a whole lot further, then without really moving a lot, then I think that would be, a sign that, again, we probably need to figure out a way to be a little more conservative as we approach Q4. And then this is a question actually one of the, I think, clients had coming into this. So thank you for submitting the question, which was, why wouldn't we just stay in money market funds now instead of going into bonds when money market funds are at, maybe 5%, a 3-month treasury bill, maybe a little bit more than that at 5.25%. And then of course, like municipal bonds, maybe a little bit lower than that. So I think it's a great question, because if you're not taking any risk at all and achieving that return that you're seeking, then, again, the risk reward seemingly wouldn't be there. So this, just to orient you to the chart here before I move forward, this is all the tenors of bonds down below. So this is the average yield on September 11th of a treasury bond that was 1 month out to expiration, and that was around 5.4%. The 1-year bond, if you just scroll up here, similar level, interestingly. But then you get out to the 5-year, it dips down pretty substantially, down to maybe 4.4. 10-year bond currently at 4.3, and then 30-year bond at 4.4. So this is what we mean when we say an inverted yield curve. And these other lines are just points in time and what those rates were for those tenors of bonds. So you can see we've come quite a long way since January 1st of this year here. January 1st, the 1-month T-bill was at 4%. 10-year bond on January 1st was 3.75. 30-year bond was at 3.9 or something like that. And you can see how far we've come since then. So this is what's known as an inverted yield curve, which means that short-term bonds yield higher than long-term bonds. That's all that means. And it generally, again, is an indicator that recession could be on the horizon, because people don't want to take a lot of risk in long-term money. But this also creates quite a bit of reinvestment risk. And reinvestment risk is really this idea that if you hold on or only own things like money market funds, well, if the Fed cuts rates significantly in response to a recession that could be on the horizon, then money market rate yields will be the absolute first thing to go lower in yields, because the underlying investments in a money market fund have a 30-day expiration. So have something like a 1-month expiration. And 1-month and 3-month yields follow the Fed funds rate very closely because of how our financial system is constructed. So, if the Fed decides to, because of a recession that's hitting, cut rates to stimulate the economy, and they cut rates by 100 basis points, well, that means at the front end, the 1 month, 3 month would go from 5.4 down to 4.4 almost overnight. So then your starting point for your yield just went from 5.4 to 4.4. And there's really no way to get that back higher unless the Fed raises rates again. However, if you invest in a bond that's 1 year out, right now, it's yielding you 5.4, you don't have to worry about reinvesting that bond until a year from now. Now, we don't know what yields a year from now are going to be, but actually, if you use this yield curve, you could actually see that a year from now, maybe bonds would be, instead of 5.4, that'd be 5, because that's what the 2-year bond is, right? And a 2-year bond is nothing more than stringing together 2 1-year bonds. So this is kind of how, people in the bond market kind of see what the future is telling them as far as where rates are going to be. And so this is what is known as reinvestment risk. So what our recommendation is, or what our portfolios have been reflecting, is that we've been kind of sticking right around here, this 3-year to 5-year range, which we think is, adequately compensating us for the inflation risk that's on the horizon still, or some of the budgetary issues that are on the horizon, because we know, particularly with individual bonds, you'll get your money back in 3 to 5 years. We don't see any utility, though, still in going out to the 10-year or 30-year bonds. And why is that? It's because 10-year and 30-year picture for not only the U.S. budget deficit, but also things like the U.S. dollar or the inflation picture, in our opinion, are much less certain than the 3-year picture, 3-year window. And that's just a function of time, right? So that's what's known as reinvestment risk. So I think what our counsel would be for anyone that is hanging out in money market funds just because it's earning you a good rate of return, that's one thing I would just mention along those lines, is that certainly your principal is not at risk. There's no question that in a money market fund, we don't believe principal is at risk. But your income rate of return could be in jeopardy if we hit a recessionary period and rates fall. So moving out the yield curve spectrum a little bit to the 1 year, 2 year, even in our target range, 3 to 5 year, could make some sense, because you're essentially locking in those rates for 1 to 5 years in that case, at a level that is pretty adequately compensating you for the risk you're taking. Certainly happy to explore that concept further with anyone that wants to, but I won't belabor it too much longer. But that's, I thought, a great question from a client that I just wanted to make sure we addressed. So here are just a few key takeaways. Still believe that a lot of what's happened so far in 2023 has been capital flow related, not necessarily fundamentals, because earnings really this year haven't grown a whole lot. It's more in aggregate in the S&P. Capital flows have really been what's driven markets higher. And of course, the PE multiple has expanded. So we really have to see this earnings resumption for us to get a whole lot more excited about where levels are for the S&P in particular. But also wanted to point out that now is a great time to be managing risk where we can. So whether it's in large cap tech companies, we've certainly taken some profits on some of those positions that we've had, or even rebalancing decisions, which we have executed one of those already this year. Or looking at other asset classes that if you don't have exposure to, like liquid alternatives or private markets, could be an interesting opportunity to start looking at those that have different risk and return profiles. Still prefer, in many cases, alternative strategies over bonds. What are we looking for to get more excited about bonds is, maybe increasing that allocation. Well, I've told our advisors, when the 5-year bond, because I just referenced that it's in our range, when the 5-year bond gets to 5%, I think that is an adequate risk and return versus what we currently own right now, and would potentially allow us to add back to our bond positions once we get to that level. And then, reinvestment risk as we get closer to this recession, if it ends up happening at all, is rising the closer you get to that, because the playbook for the Fed in a recession is to cut rates aggressively to stimulate the economy. And that would certainly not work out well for those clients in money market accounts in very short durations. So, but I just, again, wanted to highlight and underscore here that, we're not taking a lot of interest rate duration risk at the moment, just given some of the, macro variables that are out there from a budgetary demographic standpoint in the US. So still a little bit cautious, but there will be a time potentially down the road when rates get a bit higher for us to look at extending out that duration. If you have any follow-up questions or comments, I would love to hear those from you, or any topics you want to hear about. Let me know what those would be, and I'll try to add a slide in. Have a great rest of your day, and we'll talk to you all soon. Thanks.